Okay, guys. Well, I wanted to get into something real quick. Try and keep it to 10 minutes or less, because it has to do with finance, obviously, but it's just a little bit off topic from Forex. So I've talked about for a long time, my beliefs in the economy and where things are headed, and the likelihood of seeing major economic downturn. You can call it what you like. One of the things that we saw early on was a shift in CPI, and I've described this many times before, probably 100 times. 100 times a year I explain it or more. CPI is a measure of inflation essentially. It was a awesome indicator for whether interest rates are going up or whether interest rates are going down. At the end of the day, interest rates are a massive driver in currencies. They drove the trends. In normal market, interest rates tend to drive trends, that is. Nowadays, they definitely do not. I mean, they have an effect, but they don't drive the trends. So the bottom line is, back in 2005, 2006, 2007, normal market. Everything was hunky-dory. Everything was great, going well. Higher than expected CPI would lead to an increase in rates. Lower than expected CPI would result in a decrease in rates. Very simple. Increase the rates, slow the inflation, keep things at 2% or below growth, you're good to go. Lower than 2% or lower than 1%, begin to cut rates, increase inflation, increase growth until you have to hike rates later, slow it back down. So it's that constant battle back and forth. It was a great I don't want to use the word great, but it was a decent mechanism for controlling growth. Worked well in a normal market situation. 2007, 2008, 2009, we entered a very not normal situation. So for a time, we saw CPI go from an absolutely beautiful indicator that was extremely straightforward, always spiked the direction it should, always followed through in that direction after the spike, just picturesque, beautiful. If you got in anywhere near a pre-release, you're going to have an awesome trade. Okay, so there was a shift. When things started to go to hell in a handbasket, there was a shift. And that shift went from CPI being a good indicator to CPI going, any which direction, and then ultimately going the opposite direction it should. So it went from being one of the best news trades out there to a trade that went literally the opposite direction. What happened? Well, what happened was the tanking of the economy. So CPI, when it was positive, what did that mean? That meant that they had higher than expected or wanted inflation. How do they curb higher inflation? They hike rates. But now we have a situation where the economy's in a crap hole. So if we have higher than expected CPI, we cannot hike rates. So because obviously the economy is slow, and if we hike rates, it'll slow it even further. And so they were stuck between a rock and a hard place. They had higher than expected inflation, but they couldn't raise rates to curb that inflation because of the slowing economy. So that at that point, there was a shift, and that shift started CPI spiking the opposite direction. This is back in 2009, 2010. Actually, it might even been before that. Time flies. It all runs together now. But anyways, in that time, during the time when things were really collapsing. So there's been this massive dumping of interest rates, and this is what really I'm getting to. It's a long roundabout way, as I like to ramble. So we've had this dumping of interest rates down to extremely low rates. The ECB goes below the rate they never said they'd go below, and we're at historically low rates. Okay, not just in Japan, but worldwide, we're at historically low rates. So with that being said, we're at historically low rates, and they still cannot stimulate growth. The economy is still in a crab hole. If you read Zero Hedge, you'll see every day facts to show you that Things are sideways at best and going down slightly, really going down slightly at best. So if inflation ever gets out of control, they will have no choice but to hike interest rates. Why is this important to you? Because it's going to affect the way you live. It's going to crash things much faster than things happened in 2007, 2008. Everything is right on the brink. And when you have rates across, when prime begins to rise and you have rates going up across the board because of this inflation that's inevitable, you will have one of the fastest downturns that you've seen, probably faster than 2007, 2008. An extremely fast reversal of this recovery, and I'm doing the little quotations with my hand, this BS recovery, everything will be erased extremely quickly. And one of the reason I mention this is because we're looking at houses, and rates are, the rate we can get is, we were able to get, I think it was 3 1/4. Don't quote me on that. It actually was 3 1/4. So we were able to get 3 1/4, which is a pretty decent rate for a house. Honestly, in America, for a house, that's absolutely great rate. Most people have rates at 4 or 5% or some higher. So a couple weeks back, all the banks began to raise their rates. So it went from 3 1/4 to now 4%. However, prime has not risen. Now, what does that tell you? Now, if you guys don't know what we do here, we trade bank manipulation. So what that implies is that the banks manipulate the market. Now, they do this out of necessity. It's not anything negative that they're doing. They're simply fulfilling the natural flow of the market. They're finding buy orders for their sell orders. They're finding sell orders for their buy orders. They're not doing anything bad. They're not doing anything negative. It's just what they have to do to enter markets, as well as exit markets. Now, probably there's some negative manipulation in there somewhere, but let's just assume it's all rosy, hunky-dory. They're just fulfilling that purpose. But the point is, they know what's happening before it's coming. And so when the banks do something before in this case, before interest rates have risen for the public, you need to pay attention, because this is the catalyst I've been talking about for a year, that when prime does begin to rise, which it has not, but when it does, it's going to be catastrophic for the economy. And so is it 100% sure that this raise in house rates is a 100% indication that rates are going to hike? No, it's finance. There's no such thing as 100%. It's not even 100% for the banks. Because they don't work together, you could have a group of banks railroad another smaller group of banks. It's definitely possible. It happens. It's probably one of the reasons that we see manipulation then take a loss on a trade. Those losses may be where a bank gets railroaded. Do we know exactly why? No. But the point is, again, nothing's 100%. However, historically, rates have risen ahead of prime interest rate rises. And that's an extremely important trend for you to realize. Because these rates are going up, it is an extremely high probability that prime will be increasing, maybe 6 months down the road, maybe a year down the road. Maybe I'm full of crap and it's never going to happen. And when it does, it'll be hunky-dory and, awesome Ben Bernanke will have saved us from the economy. Maybe that's true. And I hope that's true. I hope everybody in this room, and especially Sam, calls me an idiot and says, Sterling, you're wrong. But what's the harm in preparing a bit for the worst case scenario? And that's what I'm getting at, guys. Right now, we have a very limited window, in my opinion. You have a very limited window to protect what you do have. Physical assets are the way to go. I've harped on this a billion times, but now we're seeing the signs. I've said about the hiking of interest rates is going to be the catalyst. I've said that for 6 months or a year, and now we're starting to see it where I believe it's coming. And I believe it's extremely close. And in finance talk, that's not, tomorrow or the next day, but in finance talk, a couple months, 6 months, 8 months down the road, that's very, very close. So I'll just say this: if you've been, everybody in this room has been warned multiple times, and if you do nothing about it, that's your own fault. But you've been warned. If you're concerned about what to do, use your head. Physical assets. If it's physical, then it can't be manipulated. Gold, silver, property, storable food is gigantic. If you just, really, guys, the physical stuff, and I'm telling you, the way they can control you is through your food. eFoods Direct has storable food. Storable food is one of the best investments out there. Let's say you never eat any of it. It will never lose value and will only go up in value. As far as an amazing investment, look at the price of corn. Look at corn futures. Look at any futures price of food, of mainstay food, and it's going up. Okay, the quick spiel on gold. Here's the quick spiel on gold. In 1915, 1920, whenever the first mainline production cars are coming off the line at Ford, an ounce or 20, 25 ounces of gold bought you a standard production car back then. Right? $20 an ounce. $20 an ounce times 20 or times 25 is, 400 or $400 to $500. Standard price of an automobile back then. That was the price. If you want to look it up, go back, check it out. So 20 to 25 ounces bought you a vehicle. A nice, the standard average everyday automobile back then. Not a Duesenberg, standard automobile, Ford, whatever. Nowadays, 20 to 25 ounces buys you a nice standard automobile. Buys you a nice Ford. Again, the point I'm getting at is the buying power of gold over time never changes. You will not make money with gold, and you will not lose money with gold. Had your grandparents bought gold at $20 or whatever, grandparents, great-grandparents bought gold at $20 an ounce, and had they been rebels and not turned in their gold, if they had 25 ounces of gold and they bought it back then and then handed it down to you, there would have been no money made, even though gold has gone from $20 an ounce to now $1,400 an ounce. Nobody would have made money on that. The reason nobody would have made money on that, even though there was a $1,300 and $60 or $80, $1,380 change per ounce, is because the buying power is exactly the same. You can still buy the exact same thing. So the only reason I worry about the price of gold is because I want it to go lower so I can buy more for all the idiots that are selling at this price, because it doesn't matter what the price of gold is. The buying power will still be the same. So you have to understand why you want gold personally. If you want gold as a short-term investment, then you need to be concerned with the short-term price, because yes, you can lose or make money in the short term, because inflation does not change as fast as the price of gold. However, if you're looking at it as a wealth preservation tool and you plan to hold it for 20 or 30 years, and it's part of your retirement, or 10 years, or let's say 10 years or more, and it's part of your retirement, then the price of gold means jack diddly squat. Because gold today will buy the same amount 10 years from now, and it'll buy the same amount 50 years from now. And if you buy gold at $2,000 an ounce, or if you buy gold today at $1,400 an ounce, and then 10 years down the road, it's $5,000 an ounce, you did not make any money. The reason you didn't make any money is because gold will still buy the exact same thing. So that's what's important. Its buying power is the same, period. In the short term, that's not true, but 10 years or longer, that is always true. History has always proven it. APMEX is a good seller. They have solid prices. What I always recommend doing is purchasing in quarters. So what I mean, quarters of the year. So don't buy once a month because you're going to get ate up with shipping charges. Buy once a quarter. You know, go, okay, so save up your money for 3 months and then purchase your amount, or even every 6 months. You know, right now we may not have that much time, so you may want to buy once a month. You're going to pay a bigger premium, but again, the price of gold doesn't necessarily matter all that much. The only reason I care about the price of gold, again, is because I want the lowest price possible to purchase at, but I hope it even goes lower once I buy, because then I just simply buy more. Junk silver is another great way. Junk silver is great. Everybody recognizes it. In a time of collapse, it'll be able to be used easier than anything. While we're on the subject, guys, keep this in mind. I don't care if you have 100 ounces of gold in a wheelbarrow, and you come up to a person in a collapse situation, and they have the last loaf of bread. No matter how much gold you want to trade them for the last loaf of bread, they'll tell you to hit the road, Jack. So keep that in mind. That's why I say storable food. And you can, you know, people can think I'm a quack now, but it's happened before in this country, and this country's much less prepared now. You know, back in the Great Depression, 80 or 90% of the U.S. and the people that lived here were somehow involved in agriculture, and now it's less than 10%. And I believe the number was around 3%. I just don't want to quote an extreme number and be wrong. So that's why I'll say 10% just to be safe. So we are so less sufficient. We don't know how to grow our own garden. We don't know how to, produce anything for ourselves. And because of that, if the situation was half as bad, it's going to be 10 times as bad for the people. In other words, if the economic situation is half as bad, it's going to be 10 times worse on the people because they know nothing, and that's the point. All right, guys, let's get back into Forex. It's a very important part. It is as much to do with your success as what you learn here, and that's why I talk about it, because it's probably gonna affect people relatively quickly. You know, and at the very least, I just have to say something to clear my conscience. If I don't have anything where if I just keep that to myself and everybody gets screwed that I have contact with because I didn't say anything, then I'm going to feel horrible about that. At least if I say something, it's on the individual now.